Greetings, everybody. Welcome to Liberty Call. Today is Thursday, March 2nd, 2023. I hope everybody's having a fantastical day out there in the interwebs. Much better day on the markets, it looks like. I see a lot of green here domestically. I'm sure that'll make some people happy. Other people like myself, which are waiting for everything to fall apart. Not so much. Just kind of sitting here, twiddling my thumbs, waiting for the market to collapse, and so we can get back in the market later and make some money, hopefully. That's the goal. All right, if it's your first time watching the Liberty Call, please give me some thumbs up, likes, shares, subscribes, follows, all that good crap. I'd greatly appreciate it. Let's go ahead and jump into the numbers, folks. Dow Jones was up 1.05% today, closed at 33,003. S&P 500 was up 0.76, closed at 39.81. NASDAQ up 0.73, closed at 11,462. The VIX fell 4.81% today. It's currently at 1959. Still too close to that 20 number that I use as a caution. Canada was up 0.38. Brazil down 1.01. Mexico down 0.27. All right, our friends across the Atlantic in Germany, they were up 0.15. UK up 0.37. France up 0.69. The Netherlands up 0.77. Spain up 0.05. Italy up 0.3. Switzerland up 0.99. And Portugal up 0.75. Russian exchanges were both in the red today. The MOEX down 1.11, RTSI down 1.38. And the overnights in Asia, I see mostly red. The Nikkei in Japan was down 0.06. Australia up 0.05. The Chinese markets, the Shanghai was down 0.05. The SESE component down 0.54. China A50 down 0.32. DJ Shanghai down 0.12. Hang Seng down 0.92. Taiwan weighted was flat at 0.00. All right. So it looks like kind of the opposite of yesterday. The overnights were red in Asia and then more green as we got further west. And so kind of the opposite of the previous couple days. All righty. Well, let's go ahead and go through today's market recap, see what they had to say. Put it on the screen there. All right. SP 500 jumps as Fed's Bostic rules out support for return to aggressive Fed hikes. Again, these journalists have been praying and hoping and wishing that people would stop raising interest rates. And, at some point they'll get their wish, but I think, things are not going to go the way they would like. All right. On Thursday, the SP 500 rallied after pairing losses as Treasury yields eased from session highs. This was after Atlanta Fed Reserve President Raphael Bostic ruled out backing a return to more aggressive Fed rate hikes and said the central bank would pause by mid to late summer. Bostic stated that he was still firmly in the quarter point move camp, which eased worries that the Fed could be forced to revert to more aggressive 50 basis point rate hikes following strong economic data. This came after data showed a jump in labor costs in the fourth quarter and fewer than expected initial jobless claims pushed the 10-year and 2-year yields to levels not seen in more than a decade. The strong economic data and hawkish remarks from several Fed members earlier in the week have forced some on Wall Street to price in more aggressive Fed rate hikes and lower earnings. Wells Fargo pushed back its call on a recession and now expects an economic downturn in the second half of the year, with interest rates expected to stay higher for longer. Who has been saying that? This guy. They reduced their year-end 2023 target for the SP 500 index and raised their target range for federal funds to 5.25 to 5.25 to 5.5%. I think they had settled that it would probably stop at around 5. So they're going to go 0.5% higher. I don't know if that's really going to do much. Financials were the biggest drag on the market, with regional banks leading to the downside despite a surge in yields, which tends to boost margins on lending. Principal Financial, Signature Bank, and Zions Bank Corporation were among the biggest losers of the day. Cryptocurrency bank Silvergate Capital Corp extended losses after delaying its annual report and raising concerns about its ability to survive following the impacts of the collapse of FTX and the slump in the crypto market. Utilities and consumer staples were among the top gainers on the day, with the latter also helped by a 5% jump in grocery chain Kroger. Let's go Krogering. I'm sorry, that was an ad from the 80s. Kroger reported better than expected guidance that overshadowed mixed fourth quarter results as revenue fell short of Wall Street estimates. Macy's reported quarterly earnings that beat expectations, sending the department store chain changed shares more than 10% higher. Goldman Sachs stated that they were encouraged to see the well-controlled inventory balance entering the year and believed that strong momentum and clean stocks suggested an opportunity for Macy's to generate a healthier profit than peers for the year. Salesforce surged more than 12% after reporting fourth quarter results and guidance that topped Wall Street estimates. Wedbush said this news, quote, will silence the doubters, end quote, amid ongoing activist investor interest in the cloud-based software company. All right. So the people at the Fed are saying that, oh, well, we're not going to go much higher. Calm down, people on Wall Street. You know, things are going to turn around sooner or later. Then now they're up, the other side of their mouth, they're saying, yeah, well, or the people at Goldman Sachs are like, well, we're going to push back our analysis and we're going to think things aren't going to be as good this year. So which is it? Are they going to start raising rates or lowering rates, which is going to push up the stock market? Or are they going to keep raising rates, which is going to, be put more pressure on growth stocks, which is going to put more downward pressure on the market in general. So we shall see. I would put my bet that the Fed will cave at some point, but they'll probably wait too long, and it won't really make a difference. All right, U.S. labor market stays resilient. Q4 labor costs revised higher. All right, let me bring up my notes here. The number of Americans filing new claims for unemployment benefits fell again last week, marking the seventh consecutive week that claims remained below 200,000. The sustained strength of the labor market, despite risks of recession, is contributing to elevated inflation via solid wage gains. The tight labor market has led to fears that the Federal Reserve could keep hiking interest rates for longer. Labor costs grew much faster than previously estimated in the fourth quarter, with unit labor costs rising at a 3.2% annualized rate, revised up from the 1.1% pace reported last month. The core personal consumption expenditures price index, one of the measures tracked by the Fed for monetary policy, increased 4.7% in January. Hourly compensation grew 4.7% in 2022, averaging 5% in the past 5 years, well above the 3% that's viewed by some policymakers as compatible with the inflation target. Despite high-profile layoffs, particularly in the technology sector, economists and policymakers say that these companies hired too many workers during the COVID-19 pandemic and were not representative of the overall economy. The labor market shows no signs of deterioration, and minimal job layoffs will harden the resolve of Fed officials to slow economic demand down with higher interest rates, according to Christopher Rupke, chief economist at Forward Bonds. The resilience of the labor market and stubbornly high inflation have increased the likelihood that the Fed raising interest rates at least 3 more times this year instead of twice. Stocks on Wall Street were trading mostly lower, and the dollar rose against a basket of currencies, and the U.S. Treasury prices fell. The number of people receiving benefits after an initial week of aid fell 5,000 to 1.655 million during the week that ended February 18th. The so-called continuing claims, a proxy for hiring, covered the period during which the government surveyed households for February's unemployment rate. Continuing claims fell modestly between January and February survey periods. Economists expect strong employment growth in February, although the pace probably slowed from January's blockbuster gain of 517,000 jobs. All right. So looks like the labor market is still cooking with gasoline. So like I said, that it's going to put pressure on those at the Fed to continue to keep rates elevated. I imagine they're probably going to stay high through the end of the year. I mean, unless something catastrophic occurs. But granted, our government could come up with another great excuse or catastrophe to print millions or trillions of dollars. I mean, COVID was a great excuse 3 years ago. So we'll see what they come up with next. Maybe the bubonic plague. That would be fun. All right. Last up, I got an article here about the petrodollar, Saudi Arabia's quandary, the end of the petrodollar. All right. This article discusses the origins of the petrodollar and its impacts on the global economy. In 1971, the U.S. abandoned the Bretton Woods Agreement, a system that backed the U.S. dollar with gold. This left a vacuum in the global financial system that needed to be filled, and the dollar remained the default currency for international trade, despite no longer being backed for gold. In 1974, Henry Kissinger brokered a deal with OPEC that created the petrodollar, in which oil would be traded exclusively in dollars. Saudi Arabia, the world's largest oil producer, agreed to the deal, making the dollar backed up by a valuable commodity that would always be in demand. The petrodollar gave the Fed extreme license to print currency and export inflation, while giving the U.S. and the Gulf states enhanced access to the world's reserve currency. Holding the world reserve currency has also given the U.S. a free ride with far less need to produce valuable goods and services. The dollar is backed up by as the world's reserve currency by a series of secondary institutions, the International Monetary Fund, the World Bank, etc., and an unspoken military and intelligence enforcement mechanism. Yeah, basically our military is what keeps the petrodollar running, because if you don't want to use the petrodollar, we find a reason to invade you. Opposing the petrodollar could lead to a country being invaded or targeted for subterfuge. Libya, Syria. All right. The article also discusses the consequences of the petrodollar. The business cycle consequences of inflation are unavoidable, and holding the world reserve currency has given the U.S. a free ride with far less need to produce. Yeah, we already talked about that. However, there are consequences involved. Recent actions, such as the printing of more dollars in 2021 than the entirety of the currency's history, destabilized the global financial system by creating mass inflation. The sanctions imposed on Russia also exacerbated the situation. The fact that the West has turned a regional conflict into a proxy war and destabilized the world economy due to ideological frenzy and a desire for a one world government has disturbed many other powers. They have suffered from economic chaos and are concerned that the West could leap into these disputes in the same way they have attempted to crush the Russians. All right, so we shall see how much longer the dollar lasts. I would put a healthy wager that the U.S. federal government and the U.S. dollar will probably not be in existence in their current forms by 2030. That's just my own personal guess. But we shall see what happens long term. All right. Well, that's everything I had for today. I hope everyone has a fantastical evening. I'll talk to you guys next time. Adios.